Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, October 26th, 5:38 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we remain in a longer-term correction, still down about 20% year to date, which meets the technical definition of a bear market. However, in a short-term uptrend, since the follow-through day last Friday, leading stocks continue to, for the most part, act pretty well. We're seeing breakouts. We're seeing earnings gaps up that are holding for the most part. We're also seeing some earnings blow-ups as companies that disappoint really get taken to the woodshed. See over here on the trend gauge, we've got leaders in bullish / uptrend mode, acting fine. Our short-term trend indicator, this is where are ask the question, where are the 5 major indexes relative to their short-term 21-day exponential moving average? And the answer is they are in a bullish / uptrend. Ask the same question for the 50-day moving average, and we've got a big mixed bag here. We'll go over that later, but the net result is bearish / downtrend with a green arrow, as we're seeing some indexes try. We're seeing some indexes rejected at the 50-day. We're seeing one index not quite there yet. So it's a mixed bag there. All 5 of the indexes still below their long-term 200-day moving average, and I'll explain how we use all this to manage money, how we incorporate this into our process in a little bit, as I do in every video. So what just happened today? It's a colorful day today. Early we had a nice, we had a gap down that reversed to a positive day 4 up and was looking to make a fool out of everybody that was bearish with the big earnings misses in Microsoft and Google, but we then had a very harsh reversal. I think we just got too far in too short a period of time, a reversal and a trend down at the 50-day moving average for the S&P 500, and we trended down to just about exactly where we opened, to red. So mixed bag on the day. Mixed bag on the indexes also. Growth stocks outperformed today. The G6, this is our in-house 6 growth ETF composite, up 0.47%. S&P 500 down 0.74. NASDAQ 100 really hit hard. Came within 0.5% of turning red despite the big moves down across many of the former darling FANG stocks, but closed near the low on the day, about 50 cents off the low of the day, down 2.21%. Dow just about flat on the day. Mid caps positive by 0.2%. Russell 2000 small caps up 0.46%. Global diversified 60/40 stock bond up 0.12%. In-house down 0.37%, giving back a little bit of the prior 2 days gains. We'll bring up the tail of the tape and charts of interest when we go over, when we hit the chart section. We're going to look at 2 handfuls, maybe about a dozen gaps up on earnings. So always want to keep these on your list to see how they react and to see if they turn into former leaders. When you see something gap up on earnings, it means that Wall Street was offsides in their estimation of what the earnings were supposed to be, or they had a big catalyst that nobody knew about, or they really upped guidance going forward. There could be several reasons, but the bottom line is that gaps up that hold are good. They're especially good in a bear market, as these frequently turn into the leaders. If they gap to new all-time high, they're by definition a leader, and we'll take a look at some charts that fit that bill. So let's get into it. First off, let me tell you why we do what we do here at Revere, and this chart of the S&P 500. Pretty much, they say a picture's worth 1,000 words. I'm going to say this in less than 1,000 words, but we're trend followers at Revere. That means we take a look at where the major indexes are relative to their trends. A short-term trend being the 21-day exponential moving average, the green line, the medium-term trend, the 50-day moving average, the red line, the long-term trend, the 200-day moving average, the black line. When we're trending above all of these and they're configured the way they are, we are as long in the market as we can comfortably be. Not all rallies last, though. Uh, when we start to roll over or consolidate, we don't know if it's going to just be a consolidation or if it's a correction, but our stops will take us out of the market. And if we really start to roll over and the slopes of the lines start to roll over, we will really raise a significant amount of cash. And then the big bad black line that we're all looking at under the 200-day moving average is when we turn up the defensiveness to a maximum level, and that's because of this chart right here. The last 13 bear markets, uh, we have seen at Revere plenty of friends, family have their retirements devastated because they had their money being managed by people who had no sell discipline. Call it willful ignorance, call it unconscious incompetence. The law is actually on the side of the person that holds the portfolio. There have been several court cases decided and said just if you're a fiduciary, you're responsible for protecting your client's downside. You just can't let it go down and blame it on the market. But there are a lot of pie chart advisors out there, and that's just what they do, hoping they don't get sued. But we treat downside protection as job one at Revere. You can see these highlighted areas. These are severe bear markets, the average of the 6 being 44.5%. You need 80% to get back to even. If just for the average, if it's down 50%, you need over 100% gain to get back even. This most recent one where we are now, top to bottom, down 27.5%. You need a 38% gain to get back to even. If you're in 6 months from retirement, say, you can't afford to have a big hit to your portfolio, to your nest egg, to the savings that you are counting on using for your retirement. It takes too much toll on your physical, your emotional, your mental, your financial capital, and that's why we protect the downside, let the upside take care of itself when the market is healthy. And speaking of healthy, we get out under this 200-day moving average, but we've got rules to get back in. They start with some tactical entries, short-term trend signals that we get, like a big shakeout and reversal, such as we saw on 1013. Follow-through days, such as we saw on 1021. Moves above the 21-day moving average, such as we saw last week and firmly saw Monday and Tuesday of this, last Friday and Monday of this week. We've got some signals to get defensive, like when we fail into declining moving averages, such as happened today. We'll talk about that when we review the portfolio changes. And here's a big failure. This was a nice rally. We carried this higher. It failed into the 200-day moving average. Market wasn't ready yet. Is the market ready to get back to it and give it a shot again? We don't know, but we've got rules either way. And if you're interested in this approach, give us a shout. Email me, don@revereasset.com. You can also email Revere President Danny Stewart. He's a CFA, the king of all things financial, dan@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So you can see, as I mentioned, the S&P 500 3 days up. I talked about showing some caution today. It looked like I was on the right side of that with the gap down this morning, gap down 0.85% at the open. Most of that was because of Microsoft and Google's negative reaction to earnings. Here's the gap down, but that's it. The low was put in right away. And man, we just started squeezing higher, and it looked like this market was just incredibly powerful. And these earnings sell-offs for these two stocks didn't matter, and small caps and mid caps were up about 2%, and then we just ran into 38.86 and we just ran out of gas. You don't need an explanation. Basically, what you saw here is an inverse cup and handle that then broke out to the downside and bounced a little bit into the close. We're up slightly after hours, not much. The NASDAQ is down because Facebook/Meta earnings were just absolutely brutal. But bottom line is right now we topped at 38.86, so we went from a day 4 up to a day 1 down as we came down this cup and handle. But this 38.25 area seems to be a pretty strong area for support. It held it yesterday on the pullback. That's where we opened today, and it held it on the pullback again today. So that's the area that we want to hold, and that actually is an area that we had marked as a support / resistance area. So makes sense to hold there. We don't want to go below there. And actually, when we held there and started trending higher this morning, we added to some UPRO. The thought for the day, the expectation was for an inside day today. The strength, we dipped a few more toes in the water, got stopped on Chipotle as that just flat out didn't work. We got stopped for a 7% loss on that. And then when this failed into the close, we put a little bit of a hedge on. I'll talk about that when we get to the tail of the tape and go through the portfolio changes. So here's the NASDAQ 100, didn't quite make it to the 50-day moving average and closed below yesterday's low and is down slightly after hours let's take a look at Meta. I mean, this is just garbage. It's turned into, I guess people are just tired of Facebook. He's betting the company on, look at that, down 18% after hours. Zuckerberg is betting the company on the metaverse, and people are just laughing right now. So this stock has gone from almost $400 down to $106. So stocks, there's no such thing as a hold forever stock, as far as I'm concerned anyway. Let's go to the Dow Jones Industrial Average. You can see 3 closes above the 50-day moving average now. This is the leading index. Ran into this 32,000 area today and reversed. We'll see what happens as the rest of the week unfolds. Mid caps, first close above the 50-day moving average, but at the bottom of the range. Note the slope of the line going lower is, it kind of plays a little bit of games. You could stay above the 50-day moving average and continue to trend lower. That doesn't benefit anybody. So you have to take moves against these declining moving averages when you get above them with a little bit of a grain of salt. Nice to be closed above. We want to see it firmly above, though, not just hanging around right around where the moving average is. And small caps, same situation. Poked their head above today, but basically closed right on it. And it's a downsloping line too. Some things that the market had going for it today, but not all of the indexes benefited, but really that probably has a lot to do with the FANG stocks weighing down the big cap indexes. Break below the 50-day moving average for the dollar today. So some protracted weakness after being long for an extended period of time. This is beneficial to stocks. Especially a weaker dollar is especially good for multinational stocks, which the Dow Jones Industrial Average is loaded with. So it's another reason why the Dow is outperforming. Let's take a look at TLT. Bond prices were up today, which means yields were down. So there's a 2-day bounce on TLT. TNX, let's check the yield on the TNX, has pulled back to around the 4% area. You can see the stochastic rolling over. That is a headwind against this going higher, against rates going higher. Bitcoin broke briefly above 21,000 in this breakout area that we had mentioned today. I got alerts at this 1250 area yesterday and today, pulling back a little bit. Let's refresh these alerts. So for now, Bitcoin breaking out above this 12.5 resistance area, but you can see it kind of pulls back. It's moving with the S&P 500. It's you can see it pulling back here in the day, and the VIX now firmly below the 21-day moving average. Let's go to a daily chart. And also first close below the 50-day moving average. Same thing in reverse versus the indexes. I mean, this could continue to trickle higher and stay below the 50-day moving average, but it would be going higher. So again, the slope of the line matters. We need to keep an eye on it, and we're coming into oversold on the VIX. So market probably, I don't predict, but could be some time for consolidation. We just went too far too fast on this 4-day up move. So let's get to the tail of the tape, see what's changed. Technicals still the same as yesterday, which is positive. Put call 0.94. VIX down today. as I said, now below the 21 and the 50-day moving average. Fear and greed up too. It's on the edge of neutral versus greed. We're operating under the bull case now from a short-term perspective. Some news at 10 a.m. and this really jolted the stocks higher. The Bank of Canada blinked. They were expected to raise 75 basis points. They went with 50. This is the second major bank to do this. I think it was Bank of Australia did it first, raised less than they wanted to. And the market is hoping that the Fed catches on to this and stops raising. And that's part of the reason for the rally that we're seeing. So we went today up 3, today down 1. Big earnings after hours tomorrow, Apple and Amazon. Expectation was positive to neutral today. Positive because we're in a follow-through day. Neutral because we had already had 3 days up in the negative earnings from Microsoft and Google, and we saw the negative reversal. So we got a little bit of everything today. 3860. We got above this resistance area but closed back below it today. Notice on the pullback today we held this 3800 to 3815 area. As long as we're holding that, this rally is intact and strong. Definitely an area to keep an eye on tomorrow. NASDAQ 100 spent the day between the support and resistance areas. Bonds strong today. Oils were strong. Gold stocks were strong. Biotech strong, and positive reaction to Enphase's earnings last night propelled the solar sector. It's trying to make a comeback. Dollar down, C&K, which two of the tech sectors down, stocks down, software down. Focus today coming into, could Microsoft and Google shake off the initial negative reaction? They tried, but certainly closed. Google down 9%, Microsoft down 7.8%. Breakouts for the most part are holding. Indexes VIX and the dollar versus 21 all acting the way we wanted it to today. So what did we do in the portfolio? I talked about how we added to UPRO on that pullback that held this 3,800 area and started higher. We did 2 adds today. We added 1% to Shockwave. Let's take a look at that chart. Was up much bigger than where it closed today, above 300, and it started to pull back. We added around 304, so that second ad we're a little underwater on. And CMG just absolutely didn't work at all. We bought it after hours on a gap up. As the conference call went, it got worse and worse, and it gapped down, and we hit our pain threshold on the gap down. When it broke below the 21, we sold around 1540 for a 7% loss, 6.7% loss. So net to the portfolio was what we target, max target 0.20% hit to the overall portfolio. Those are paper cuts that are easy to come back from. And then, as I said, we hedged. Basically, we hedged what we bought for UPRO as the second buy is underwater, and the first buy is right at break even right now. So bottom line, early best case for the bulls, but it turned to a negative reversal at the 50-day moving average. Here's this big 50-day moving average at 38.59, which is where we ended up closing yesterday. We're now below it with the 38.31 close. This big area here, 3800 to 38.15. This needs to hold on any pullbacks, or we may have to reassess our exposure. The exposure, we went out today just a little bit more than what we came in with the buys, the sells, and the add to Shockwave. So let's look at these. Let's look at these gaps that I was talking about. Earnings gaps frequently turn into leaders in no particular order. Well, let's sort them by 3-month relative strength. Okay, that's how this is. This one's getting a lot of attention. MEDP Medpace, big gap up on earnings. Day 2 higher high, still closed higher on the second day, but let's look at a weekly, and this big cup breakout might need to put in a handle before it can take off. That's really what we're preferring. But hey, it's a stage 1 base, great reaction to earnings, relative strength, fantastic. It's a medical stock. Those have been outperforming. So let's keep a close eye on that one. We are. Netflix, we own this. We bought the earnings gap up, and it's continued to work higher, got above the 200-day moving average and is showing some leadership action over the last 6 sessions. CALX, another is a computer stock, gap up on earnings despite a 3% loss. I guess it was the sales growth that excited people, but up 18% on 251% above volume and a day 2 higher high that closed in the top of the range. That's good behavior. Steel Dynamics, not necessarily a gap, but a great reaction to earnings and follow through strength to the upside. Intuitive Surgical, chart was broken, earnings gap up, and it's had 5 days of a positive close now, back above the 200-day moving average. Champion X, oil driller, big gap higher on its earnings numbers. AJRD, Aerojet Rocket, Aerospace and Defense, has been outperforming. This had a big gap up on earnings, pullback below the pivot today. Wing, and here I see Wing, I think Tommy Likey Wingy from Tommy Boy. And gap up today, big volume, 469% volume, up 15%, top of this flat base. Certainly, really the reaction when we were looking for in Chipotle, we didn't get it, but you got it in Wing. And it's a lower priced menu, so maybe that's fitting what's going on with the overall economy. Archer Daniels Midland, gap through the handle on earnings, nice relative strength. CSGP, New and CoStar Group, market research, gap up on earnings, 65%, volume not wonderful, but flat base. They survived a secondary offering that they recently had, and that's looking good. IDEX Corp, machinery company, loved the earnings, relative strength at a new high, gap out of this cup and handle base. And finally, Enphase, this is what has put solars back on the map, closed mid-range today, big gap up. This was a leader from its last earnings report before rolling over, but now put in a bottom, gapped up on earnings. This 300 levels looking like resistance. That's the area that I'm going to be focused on, but closed mid-range and certainly don't want to go below today's low, which is the 50-day moving average. So 12 gaps on earnings to keep an eye on for potential leadership. And that's going to wrap it. As always, like to hear from you. Don at RevereAsset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market. It's how much of that you can keep. And with that, I will wrap up today, Wednesday, October 26th. Don Vandenbord with Just the Facts. Thanks for listening and have a great day.